bring in Narendra Kumar, the CEO of Value Research and our in-house mutual fund expert. Narendra, thank you so much for joining us on Investor's Guide. Let's get straight to our very interesting portfolio question. Well, Jagjit Singh has written in, Narendra, he's 31 years old. He has two young daughters. He tells us one of them is 6 years old and the other one is only 7 months old. And he sent us such a wonderful challenge to start the show with this week. He wants to save 100 crore rupees for his children and he wants our help. Now, he's checkmarked all of the boxes. The family has insurance. He has a term cover of 2 crore rupees. He has 2 LIC policies for which he pays about 1.5 lakh rupees a year. I'm not so sure he needs them though. Savings of 30 lakh rupees in his fixed deposit, so that's his emergency fund. He has an annual income of 5 lakh rupees from his agricultural land, which of course is over and above the money he makes from the business that he runs. And he tells us that he have property in Mumbai worth about 3 crore rupees. He's setting aside 1.6 lakh rupees in mutual funds every month to achieve this goal of 100 crore rupees in 25 years. Now, those are lucky children. Their father has a very clear, very set out goal. He's obviously gone about his portfolio in a very, very clear manner, Narendra. So first, I must admire the manner in which he's designed his portfolio. If we do some rough back of the envelope calculations, according to me, if we count the fact that his property might grow at about 10% a year in Mumbai, that 3 crore rupees should come up to nearly 32 crore rupees in 25 years. And then are his mutual fund investments as well. So he should come close to about 85 crore rupees at the end of 25 years if we combine the two. Would you like to give him some advice on how he should maybe increase that mutual fund contribution?
You know, one is to get to start with a target of 100 crore, and if you get pretty close or if you surpass it, of course if you surpass it, you cross that, you won't be unhappy. But even if you get very close, it's reasonable. And the other is that, you know, I would say that he should stick to his plan. It is very important that next 25 years he will get all kind of temptations. One, he has accumulated his savings in these funds and they become meaningful. He will encounter a lot of people, a lot of intermediaries who will tell him that some magic can be done with that money, and he has to resist that. He has to keep his plan very simple. And my only suggestion is that, you know, he's investing about 1.5 lakh rupees or a little over that. It requires about 3 lakh rupees a month of constant contribution every month for next 25 years to accumulate it to about 100 crore. Assuming a return of 15%, which is not unrealistic given the time frame and given the state of our economy and inflation. But many of these variables can change over the next 25 years. But my suggestion to him will be, he should feel, he should have some kind of notional target of 100 crore, but he should not be greatly, disappointed if he's getting pretty close or, being little away from it. The only thing on which he has a control is the way he conducts. He should invest regularly, he should be into good funds, and he should try and increase his savings over time, because 1.6 lakh today, and he can, if he can grow his savings by 5% every year, that 100 crore target might look very easy.
You have to keep increasing your savings every year, increasing the amount you put in, and of course put blinders on. Don't be distracted by people who will come up to you and say, okay, you have this much money in savings and we'll be able to double it in 2 years. None of that is important. All you need to do is follow the plan that you have right now, which seems like a fairly good plan. Narendra, let's take a look at the mutual funds that he's picked out. IDFC Premier Equity, Axis Equity, HDFC Mid Cap Opportunities, Reliance Equity Opportunities, ICICI Prudential Value Discovery, Birla Sun Life Top 100, and the Axis Long-Term Equity, for which he's using to invest for his father. Now, these all seem like really good funds, Narendra. If let's look at them holistically, all of them together as a portfolio, would you like to make any changes, or do you think he's on track the way he is?
No, I think he has, chosen just the right funds, and all of them combined together, it is diversification of style, it's diversification across all kind of market capitalization, and proven credentials. So I think he should not, fiddle with this portfolio. Maybe he should review his portfolio every alternate year, and every 2 years he should look at these funds and not get distracted by, even underperformance over the last 1 year or so. Because trying to chase performance even based on annual performance may not be a wise idea when he has such a time frame, because These funds are very impressive. He should not do anything to this portfolio.
All right, so here's the advice you're getting. What you need to do right now is just stay with the same plan. You seem to be on track. And the best news of all, your target of 100 crore rupees for your children is within sight. And if you stay on this plan, it's more than achievable. Congratulations on a wonderful portfolio. Narendra, let's move on now to our hold or sell segment. Well, Anil Satya has written in. Now, he writes in from Hyderabad. He's 25 years old, Narendra, such a young investor. He manages to save 28,000 rupees in mutual funds every month and 2,000 rupees in his PPF account. Now, this is the best part. He has a family who depends on him, parents and his sister. A term cover of 1 crore rupees, health cover is already done. He wants to buy a home in the next year. And he wants to know, he has two questions. One, of course, he sent us his long-term portfolio and he wants you to take a look at it. He also wants to know that money that he saved for his down payment, where should he be putting that money for the next 6 months to a year? Because he's worried about the changes to the taxation of debt funds that happened in the budget just gone by. So he wants to know, does it make sense to just leave this money in his bank account while he goes hunting for that home over the next 6 months? Let's first address that question. What would you like him to do? 6 months' time, should he be still using an income fund or a liquid fund, or is the bank account a better option?
No, I think, bank account may not be a wise thing, because normally you get about 4% and the money is on call and you can write a check anytime. But I think he'll be better off with a liquid fund or a ultra short-term bond fund, and that will fetch him, twice as much. And, there has been a tax change, but I don't think it would have made any difference even before the tax change, because if his investment time frame is going to be less than 1 year, then even before the budget, whatever were the provision, I don't think it will make any difference. So, and also, you are unlikely to get substantial return, and, it is unlikely to be a huge tax outflow. Assuming that, it is 6 lakh rupees, and on that you earn about 10%, which is 60,000 rupee, and so 60,000 rupee will be your taxable income while you wait to choose your house. So from that standpoint, 60,000 rupee added to your income is unlikely to make a huge difference to your tax bracket or something like that.
All right, so what I'm going to do is I'm going to put on the screen right now the funds that we normally recommend, the short-term debt funds that's on your screen that you can use over the next 6 months. Narendra, let's take a look at the rest of his mutual fund portfolio. He starts off with 4 tax-saving funds, and he wants to know, since he's putting about 3,000 rupees in each of these funds, he said, does it make sense to use 4 tax-saving funds, or should he be consolidating that investment over just 2 funds? So I'll give you the funds he's using right now. He has the Access Long-Term Equity, that's been a great performer, Franklin India Tax Shield, Quantum Tax Saving, and the Religare Invesco Tax Fund. Of the 4 funds, would you like him to continue investing in all of those 4?
It's not easy to choose. He has one that he has chosen good funds. The other that it may be unnecessary, because even if he has 2 of these 2 of these 4, he'll be just as better off. And if I have to choose 2 of these 4 funds, it will be Access Long Term and Quantum Tax Saving, Quantum Tax Saver, for its sustainable cost advantage. And I don't think it's a compromise on diversification.
All right, let's move on to his other 2 funds. He has mid-cap funds, the HDFC Mid-Cap Opportunities and ICICI Prudential Value Discovery, along with the SBI Emerging Businesses. Of these 3 funds, would you like him to continue all 3?
Yes, these are excellent funds. And given his time frame, and it's a long-term portfolio, I would like him to, of course, of the 3 funds, the ICICI Prudential Value Discovery Fund happens to be a mid and small cap fund today, but it may not be always. So it can change with the time. It is a value fund, and I would like him to retain this fund for the approach it follows and the kind of return it has been able to deliver or demonstrate its ability. And the other 2 funds, surely, with all their ups and downs, they're very compelling performers.
Well, yes, the Franklin India Dynamic P Ratio Fund of Funds. This is a fund that you've recommended on the show several times, but for very different goals. Would you recommend someone as young as him continue to use this fund?
No, I would not like him to invest in this fund. I would like him to discontinue in this fund, though it's a good fund. It's a good fund for a conservative investor, but not for him who understands what he's investing for. And he's regular with his method, and he's assuming risk with his other investments. So I don't think saving him from that anxiety. And if he has taken care of his, his emergency fund, his need for short-term, his short-term needs, all those things are well taken care of, then I think, he can assume risk with equity without, he doesn't need these balanced funds and this dynamic PE ratio fund. These are conservative vehicles. And more importantly, this fund is particularly disadvantageous for a person like him because it will not be tax efficient. All the returns from this fund will not be tax free. It will be indexed and he has to hold it for 3 years. So it will be treated like a debt fund.
All right, let's move on to the other funds in his portfolio. Here's the ICICI Prudential Balanced Advantage, the Reliance Regular Savings Balanced. Narendra, two balanced funds. Again, does he need a balanced fund in this portfolio?
No, for somebody who is approaching his portfolio so methodically, he has chosen the mid-cap fund, he has chosen good tax-saving fund, he has taken care of his insurance need, and then he has clearly earmarked his long-term allocation into equity. Somebody who understands all this, I don't think he needs a balanced fund. Balanced fund is needed for a person who is who gets extremely disappointed with the wild swings of the equity market. Somebody who needs a constant, stability even with his equity investment. For him, the balanced fund could be suitable, not for him.
All right. Last on his list, he has UTI Opportunities and Franklin US Opportunities, Narendra. One of them obviously is a global fund. Let's start with UTI Opportunities. Should he continue that investment? Does it suit his profile now?
Yes, I think so. If he's dropping two of the tax-saving fund, if he's dropping the three, two balanced fund and the dynamic PE ratio fund, then UTI Opportunity is an excellent fund, and it's a more diverse fund than the other three funds that he has. So it will be a desirable hold. And also the US Opportunity Fund is a very meaningful diversification. Maybe he should ensure that it is not more than 15-20% of his total allocation, but that's about it. He has chosen good funds. He just needs to drop some.
All right, so there you have it, a streamlined portfolio there on Investor's Guide from Narendra Kumar. Narendra, it's time now to move on to our product review. This week we're looking at the SBI Magnum Tax Gain Fund. Avan will give us a quick introduction. Avan.
Thanks, Faye. This week we focus on the SBI Magnum Tax Gain Fund. Now, we all know this is one of the oldest and largest tax-saving funds in the country, with assets under management of over 3,800 crore rupees. In its long history, the fund has seen some moments of glory, like when it was a top performer in the late 90s and the bull run of 2003, when it gave a return of 132%. The period between 2004 and 2013 has been lackluster. But in the last 1 year, the fund has shown a remarkable comeback with returns of over 55%. The fund has shown a substantial recovery over the last 8 months, and it's this recovery that has led to push its rating a notch higher. Let's do the math to give you a better point of view. If you invested 1,000 rupees in this fund when it launched, you would have 9,514 rupees today. Despite its slow recovery and better options available in the market, should you bet on this fund? Do you think the fund takes back the attractive spot once lost? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you so much for that update. Narendra, if we look at the SBI Magnum Tax Gain Fund, it has recovered this year, but it's still running alongside the category average, and that technically makes it an average fund. Should we continue to rely on this fund when there are so many other tax savers with stronger performance?
No, I think this fund is actually getting impressive once again. This fund was among the best performing fund for a few years, and that attracted a lot of investors. And it had a very disappointing 2009-10, and so disappointing that that at that point a lot of investors were getting anxious that how to get out of this fund. And I think it has improved its performance, it has got its focus, and now it is managed more consistently. So I would say that this is not it is improving substantially by months, and it is good news for old old investors in this fund, as it happens to be the largest tax saving fund, and the way it is improving, I would say that last 2.5 years, the way it has been able to consolidate its position, reposition itself, and been right with its pick once again. I would say it's not a time to get out of this fund, and maybe it will soon figure as among the attractive funds to invest.
Don't get out of this fund right now. Narendra, then the next question is, if I'm looking to make a tax-saving fund this year, should I use this fund or should I use one of the better performers?
You have better performers, but all the past performance is past, and you have to look at the way this fund is improving and the way it has been able to improve its relative position too. And the way the portfolio is configured, I think this is a worthwhile bet.
Finally, Narendra, give us your rating of the SBI Magnum Tax Game Fund. Last time we talked about it, you gave it 3 stars. Would you like to upgrade it at this point?
Yes, very much so. I would like to upgrade it to about 4 stars. It is not looking great on some of the long-term returns, 5-year or 3-year return. But still, I would say that the way it is improving in the on its relative position, I would give it 4 stars.
4 stars there for the SBI Magnum Tax Gain Fund. Remember, Narendra said if you've been holding on to this fund for a while, then you're going to be rewarded now. So it makes sense to hold on to it a little longer. But Captain Vinay Pandey has written in Narendra, he's 50 years old. He's been investing for the last 10 years. He tells us that one of the investments he made in the HDFC Savings Assurance Plan has matured, and he get 26 lakh rupees from that plan. He wants to invest this money for his retirement, which is in the next 8 years or so. Now, given the fact that he's a defense person, I'm going to assume he'll get a pension, which means he won't need to derive an income from this money. We have a time horizon of 8 years. And of course, the thing that we should worry about most is the opportunity loss. Once that investment matures, don't let it sit in your bank account for too long. Make sure you have a plan and you quickly reinvest that money so you don't lose out on any opportunities. Narendra, where would you like him to invest that money?
For somebody who has accumulated his savings in an endowment plan, I would assume that he's very conservative, or he'll be very disappointed with big ups and downs in values. So he has to do 2 things. One is, of course, on the assumption that this is a long-term investment, because he has no need for current income. He's still able to save. So from that standpoint, I would suggest that he gets into 1 or 2 balanced funds from our stable growth portfolio, and spread this money, not invest all this money at one go. Spread this money over the next 12 to 18 months, not even, not in a brief period of 6 months or 8 months. And that way he'll be able to get into a more stable portfolio, and that money will be invested for at least 8-9 years. And that should grow reasonably well for him to accumulate something sizable when he retires.
All right, remember, if you have any more questions, you can get back in touch with us. One last very quick question, Narendra. Radoja Coutinho has written in, he says that on this show, especially during on budget day, we recommend that everybody get a financial advisor. He tells us he has a financial advisor, but he's paying 10% of the profits he makes on his portfolio as fees. Plus, of course, there are the taxes that he has to pay based on his tax slab. And he's saying he's losing out a lot of the power of compounding by paying both the taxes and his advisor's fees. Now, we know that advisors now charge on advice, Narendra, but as a customer, what should we be prepared to pay our advisors?
No, it's a tricky question. If your scale is small, then initially it will be hugely disadvantageous if you are paying that kind of percentage. The fee should normally be a constant. The fee should ideally be a fixed fee for the time spent, for the advice derived or delivered, rather than a percentage of your assets.
That's right. So what you could do is, if you're uncomfortable with the kind of money that you're paying, is look around for another advisor who will charge you a flat fee for the year. So it does not depend on the profits. You're paying for actually the service of the person looking at your entire portfolio and that of your families and just giving you advice. And pick someone who gives you advice that you're comfortable with, and pick someone who charges you an amount of money that you're comfortable with. That's very important. Welcome back. You're watching Investor's Guide on ET Now. Thank you for staying with us. I'm going to bring in Gaurav Mashruwala right now to answer the questions you sent in during the week. Gaurav, thank you so much for joining us. Our first question comes in from Tejvardhan, who writes in saying he wants to buy a 2-bedroom home in Bayandar in Mumbai. He has an income of 3.6 lakh rupees, but he says all of the earning members in his family together, if they pooled their resources, they have a total family income of 11 lakh rupees. He wants to know, is it possible to combine that family income and take a loan or get an allocation for a loan that's larger than what he's entitled to right now? Gaurav, banks, of course, frown on giving loans, joint loans to 2 brothers, or a brother and a sister, or a brother and a father. There are a lot of rules there. You're only allowed to borrow son and mother and husband and wife. So take him through what he can do right now and what options he has.
Mr. Tejvardhan, you will have to check with the lender as to how many number of applicants they allow. If you're talking about, here I'm looking about 5 to 6 applicants, and which most lenders may not allow. So then you'll have to pick and choose. However, my recommendation would be that instead of getting into a situation whereby you have so many borrowers and who will eventually go on to become the owners of the house, if possible, you may want to get into a situation whereby there are two small houses adjacent to each other, and one house there are X set of owners and borrowers, and second house there are another different set of owners and borrowers, so that titles are not as much complicated and the housing finance company may be comfortable lending. So instead of getting into a one house with so many borrowers and owners, you may want to split. However, if that's not possible, you may want to check with an housing finance company as to how many borrowers they would allow, because the number of borrowers will have to be necessarily be the owners of the house as well. So their names will be there in the title of the property. So don't get into too complex situation. Just evaluate options before taking the final decision.
Our next question comes in from Shekhar, whose monthly take home is 58,000 rupees. He has 5,000 rupees going into his NPS. He wants to know how he should invest for his daughter right now. She's 3 years old and he'd like to put some money away for her higher education. And he wants to put together a corpus for a down payment of a home. Gaurav, obviously, if she's only 3 years old, it means he has a nice long time horizon. Where should he invest that money?
So let's look at 5 years first. 5 years is time horizon where you should make a combination of a debt and an equity. So you may have portion of your assets in an equity fund and a portion going in debt fund. Only thing is to remember that just 1 or 2 years prior to actual requirement of this money, move entire corpus into a debt fund. So that's one. For your daughter's higher education, which seems more than a decade away, equity is an asset class and do a regular SIP into an equity mutual fund. However, focus on house first. Only once you have taken care of your housing requirements financially is when you start saving for daughter's education, because that's little far off.
Last question on the show. Krishna has written in. He wants to know what option he has right now to invest in REITs that were announced during the budget and what the limitations are. Well, first of all, let me tell you that REITs was announced, but that doesn't mean that they're available to us as retail investors at this point. There are a lot of fine print that we're waiting for, a lot of things that need to be ironed out. Gaurav, even when it does come through, is that something you would recommend to investors?
Krishna, REIT is basically a product that is called Real Estate Investment Trust. We don't have any products launched as of now, so the question of small amount and large amount and all is little far off. It's basically an investor who puts in money into a pool of funds, a scheme called REIT, which will be launched by various financial institutions, and these institutions use that pool of money to deploy into real estate sector. They could be funding the real estate developer, they could be buying property and leasing it out, or they could be getting into a joint development. So that needs to be seen as to how it will happen. When I'm saying joint development, it could be an SPV floated. Now that needs to be seen as to how product evolve. As and when it evolves, we will know the variance, and then the small investor can participate or not. Those clarity will also come in.
All right, that's a wrap on Investor's Guide. Gaurav, thank you so much for answering our questions. Remember, if you have any question at all, especially if it has to do with your insurance policy, write to us. Our email ID is at the bottom of your screen. You can reach me on Twitter as well. It'll be my pleasure to hear from you. Thanks so much for watching.